one. Only one, and it's going straight up to XLR. Let's see this. Audio check 1 2, testing 1 2 3. Audio check 1 2, test 1 2 3.
We have a Financial Institutions and Monetary Policy Subcommittee commencing at 2 o'clock. We will hear from 4 witnesses on their expertise on the subject. This hearing will begin at 2 o'clock, and we will hear from experts on financial institutions and monetary policy, so that way we can create meaningful legislation that will impact the lives of everyday Americans.
Plug it into this, and then this would Bluetooth to my hearing aids. So the only adapter we have for this is image. We're trying to put from the press feed to something to be able to steer the headphone jack. Is that possible? I don't know if it would work. No, we can try it right now. You want me to do a mic check?
Well, I was doing a mic check, but it doesn't look like this is same level. I was wondering whether or not. Okay.
Pop it in now and then.
Audio check 1 2, test 1 2. All right, and there's the audio seem to be clear.
Yeah, that works fine. Hold on. You can use that. Say again.
All right, this is an audio check. Audio check 1 2.
This is fine.
It's fine? Okay.
Can you go further up? Would that be? This subcommittee hearing will start at 2 o'clock, and this is an audio test for the witnesses.
The committee will come to order. Without objection, the chair is authorized to declare a recess of the committee at any time. This hearing is entitled A Holistic Review of Regulators, Regulatory Overreach, and Economic Consequences. Without objection, all members will have 5 legislative days within which to submit extraneous materials to the chair for inclusion in the record. I now recognize myself for 5 minutes to give an opening statement. Last week, we began a discussion of the so-called Basel III Endgame proposal put forward by federal banking agencies. Today, we continue that discussion, noting the fact that numerous other proposals have come out of the Democrat-appointed federal banking regulators over the past couple of months, with promises of more to come. The Basel-related proposal is incorrectly pushed as a response to the March banking instability and has been delivered in an underdeveloped and hurried fashion, and in many crucial areas is glaringly arbitrary and capricious. Following the Basel III and G-SIB surcharge proposals from the Fed, certain regulatory officials wasted no time in their never-let-a-crisis-go-to-waste approach to rulemaking and guidance shifting. Added to the regulatory onslaught have been proposals on long-term debt and resolution planning. In speeches, agency officials have signaled that more is on the way. A full-scale, rushed, and undeveloped rewrite of the rules of the road for the U.S. financial system is not warranted. That is especially so as officials, including those making recent proposals and stress tests, repeatedly say that U.S. banks are well capitalized and resilient. While multiple proposals have been put forward and more are likely on the way, Congress and the American people have been left out of the information flow. Indeed, members of Congress on both sides of the aisle have requested quantitative analysis, including cost-benefit analysis of the Basel-related capital proposal, but we have been ignored. No one knows how all the recent proposals work together or not, and we have no indication from the Fed, FDIC, and OCC, which are populated with armies of economists, analysts, supervisors, and examiners, of their cumulative impact to the U.S. financial system. Neither Congress nor the industry being regulated, nor the American people, including consumers, families, small businesses, farmers and ranchers and municipalities, know what to expect from the incredibly complex, interconnected, and hazy web of what has been proposed. The risks of working hastily without analytical support are high and systemic. The process of rolling out the underanalyzed Basel-related capital proposal shows clear violations of the Administrative Procedures Act, thereby running counter to the law. That proposal also contains a repeal by rule writing of the bipartisan congressional S-2155 tailoring law, done so for partisan reasons. There are some elements of the proposals for long-term debt resolution planning and G-SIB surcharges that are worthy of discussion and analysis. But a shotgun, total rewrite of the regulatory rules of the road is reckless and systemically risky. And that doesn't even take into account all that the Securities and Exchange Commission, the avalanche of rules that are coming from the SEC, how they might interact with the bank regulators here in impairing market liquidity. The interconnected onslaught of proposals and guidance overhauls threaten both individual slices and segments of financial markets and the system as a whole. We know nothing of how they all fit together or not, or what the systemic and other unintended consequences may be. That requires analysis, which the federal banking regulators in their hurriedness have not done. Will liquidity in treasury markets dry up because of the tangled web of proposals? Will first-time home buyers be shut out of the dream of home ownership? Will the car and truck buyer can no longer afford personal transportation because auto credit is too costly for most and not available for many? Will financial institutions be forced out of entire business lines, such as provision of auto credit or market making for treasury securities, leaving consumers and investors to take the hit? Will financing for new industrial projects and development in each of our districts dry up? Will municipalities find it even more costly to finance their communities? Will our loss of competitiveness in banking and finance result from the regulatory rewrite force U.S. jobs and economic activity to shift overseas, letting Europe and Asia prosper at a steep cost to Americans? These are all questions that require answers before agencies promulgate a rulemaking. However, Democrat-appointed federal banking regulators put forward this myriad of proposals to re-regulate the banking and financial system and have offered no answers. They may be belatedly beginning to look as clear flaws in the proposals are glowing in the dark. But unfortunately, markets have already begun to price in the changes given the lack of clarity on these important questions, threatening a growing credit crunch. The recent attempt by Democrat-appointed federal banking regulators to design some opaque Dodd-Frank 2.0 exercise on the cusp of a developing credit crunch needs to end. And it happens right when interest rates are higher than they've been in decades. Regulators should replace that process with proposals that deal with real problems facing our financial system with full transparency and ample input allowed. If not, as Chairman McHenry said last week, it will be American families who ultimately will suffer. The chair now recognizes the ranking member of the Subcommittee on Financial Institutions and Monetary Policy, the gentleman from Illinois, Dr. Foster, for 4 minutes for an opening statement.
Thank you, Mr. Chair, for this continuation of an important discussion on bank capital and other requirements. I was happy to join Chairman Barr in the letter to Fed Chair for Supervision requesting the more detail on the analysis and supporting data that was used to develop the Basel III Endgame proposals. I believe that having access to the data and assumptions and methodology would allow for a more informed discussion across the board here. But I think we also have to recognize that bank capital requirements and regulation is never going to be an exact science. You can reasonably model the costs of any increase or decrease in bank capital requirements or other things, the cost of compliance, of increased stress testing and so on. But there's a part that you'll never be able to model. This is how do you model the probability of financial crises? How do you model the cost of these crises, not only for the banks and the financial players involved, but for the broader economy and for the psychology of the nation that suffered a body blow, back in 2008 when a system that we thought was sound fell apart. And so that's why it's important to quantify the things that can be quantified and where important assumptions have to be made, to actually be clear about those assumptions and look at what other regulators around the world are doing for those comparable important assumptions, and then have a discussion on that basis. But I can't resist with just one closing observation, which is that the long list of objections we just heard from the ranking member, those could have been lifted almost verbatim from all the objections to the increased capital requirements that were part of Dodd-Frank. They were talking about how this would certainly drive the banking offshore and disadvantage U.S. banks and cause them to be not profitable. In fact, kind of the reverse has happened. It's been a very good decade for U.S. banks, and especially the largest ones. And I don't know whether that was a cause or an effect of the very large capital that they retain. And so I think that's an important thing to keep in mind here, that in asking a bank to control its risk has real benefits throughout the economy that cannot be quantified but are very real. And we can use our own experience over the last decade to be pretty sure of that. Anyway, thank you for having this hearing. It's important, and look forward to the witness's testimony.
Thank you. The gentleman yields, and the chair, okay, the ranking member was, I think it has, okay, she's not here. So in that case, we will move to questions and testimony. Today, we welcome the testimony of Mr. Hal Scott. Mr. Scott is the Nomura Professor of International Financial Systems at Harvard Law School. Ms. Karen Petru. Ms. Petru is Managing Partner at Federal Financial Analytics. We would also like to welcome Ms. Petru's guide dog, Pete. Ms. Meg Tyre. Ms. Tyre is a partner for David Polk, specializing in financial institutions. And Ms. Mayra Rodriguez Valladares. Ms. Rodriguez Valladares is Managing Principal at MRV Associates. Thank you all for being here, and we appreciate your testimony. Each of you will be recognized for 5 minutes to give an oral presentation. Without objection, each of your written statements will be made part of the record. Professor Scott, you are now recognized for 5 minutes to give your oral remarks.
Thank you, Chairman Barr, Ranking Member Foster, and members of the subcommittee for inviting me to testify before you today on the regulatory capital rule, which is going to be my focus. While my testimony draws on the statement of the Committee of Capital Markets Regulation regarding Basel finalization and U.S. bank capital requirements, this testimony is my own. The capital proposal would materially increase the capital requirements for large U.S. banks and other banks with significant trading activity at a time when such an increase would be both unnecessary and counterproductive. Across all banking organizations subject to the capital proposal, the amount of required common equity Tier 1 capital, which is the best measurement we have of capital, is expected to increase on average by 16%. For the largest banks, the increase is expected to be 19%. While these are already substantial increases, the increases for the subset of such banks that focus their business on supporting our capital markets are likely to be even more severe. These increases are attributable in significant part to the so-called gold plating, whereby U.S. regulators have chosen to impose standards on U.S. banks that are more stringent than what Basel itself requires. There are three key reasons why U.S. bank regulators should not increase capital requirements at this time. First, there is no need for a capital increase to maintain the stability of the banking system, as U.S. bank capital levels are strong. In particular, the average CET1 capital ratio of U.S. banking organizations for the 2001-2007 period was 8.25%. As of the first quarter of 2023, it increased by nearly 4 percentage points to 12.81%. Second, there would be significant economic costs from raising bank capital requirements, as increasing capital requirements reduce banks' lending and capital market activities, and increase borrowing costs for businesses and consumers, slowing economic growth. A 2016 report by the Bank for International Settlements summarized this extensive body of literature as indicating that for every 1 percentage point increase in capital ratios, banks tend to cut their lending in the long run by 1.4 to 3.5%. In the case of capital market activities, empirical evidence demonstrates that heightened capital requirements can have an even greater detrimental effect. The U.S. capital markets are the largest and among the most liquid and efficient in the world. In the United States, capital markets activities have a much larger role in financing the economy compared to other countries. In 2022, capital markets generated 77.5% of debt funding for non-financial corporations in the United States, whereas other large economies rely more heavily on bank loans. So these negative impacts on the capital markets are of special concern to the United States. Third, raising bank capital requirements at this time could reduce the precision of the Fed's monetary policy and thereby interfere with the Fed's ongoing efforts to fight inflation. An increase in bank capital requirements now could pose problems for the Fed's monetary policy even after inflation is contained, by counteracting the Fed's efforts at that time to restore economic growth with lower interest rates. Although the capital proposal would not become effective until July 1, 2025, these concerns are not alleviated by deferring the effective dates of the capital increase to the future. Banks generally seek to maintain buffers above anticipated regulatory minimums and respond to future increases to bank capital requirements when they are announced, immediately increasing capital even before the implementation. So I would conclude that without significant adjustments, the increases currently contemplated in the capital proposal will result in needless economic costs in the form of reduced lending and capital markets activities and will unduly complicate the Fed's use of monetary policy to fight inflation. Thank you.
Thank you. And now, Ms. Petru, you are recognized for 5 minutes for your oral remarks.
Thank you, Chairman Hill, and thank you, Mr. Foster. It's an honor to appear again before
Could you press the button to turn on the microphone?
There you go. Thank you.
Very good. And if you could reset the clock for our witness, that would be great.
Thank you.
Thank you.
It's
You
an
may
honor-
proceed. Thank you.
Thank you. It's an honor to appear again before this committee. By my count in my career so far, this is my 7th financial crisis, and thus had the honor to appear before this committee and your colleagues in the Senate several times to talk about the key policy responses to crises and failures. And I think it has been a very important control on and input into the regulatory process. But we're obviously seeing some of the same problems again, and I'd like to focus my testimony on several key points where lessons learned have not been the hard way, have not yet been fully absorbed by the banking agencies, and what we see in the array of capital resolution and pending rules that demonstrates the need for rapid regulatory process repair, but also suggests several actions this subcommittee and the Congress could take to try quickly to remedy them. I testify for myself. My firm represents major institutions, global central banks and others, but this testimony is solely my own views. I have also recently written a book called Engine of Inequality, the Fed and the Future of Wealth in America, and I will focus also on economic inequality impacts of the pending rules, especially in my written statement. So what do we know about the rules in the past and the proposals so far, and what could go very wrong? I mean, first, we know that thinking about bank profitability and competitiveness is critical, but only in the context also of safety and soundness. Banks and their holding companies are unique companies with taxpayer-provided benefits, and their holding companies are, at least by law, required to serve as sources of strength for the subsidiary insured depository, and they are also required not to engage in activities that endanger it. So we know that as the banking agencies have, that their principal focus should be on safety and soundness, not profit and competitiveness. However, to the extent that the rules adversely affect profit and competitiveness, one of the massive problems in all of the rules after the great financial crisis and the ones we see today is the quantitative and qualitative assumptions that when banks' business model changes due to rules, banks stay the same. They don't. As Professor Scott has demonstrated, they adjust because they wish to remain viable private companies. And we need very carefully to align thinking and balance thinking about safety and soundness with a full understanding of implications for customers, the financial system, the macroeconomy, and the prospects for shared as well as sustained growth. And I regret that none of the pending rules attempts to do that. They look at banks as static entities under simple and often mysterious scenarios with significant analytical problems. First, they look at each bank in its own context rather than at the system as a whole, and most importantly, at non-banks. These rules are promulgated with banking blinders, and the United States has the most significant, the largest non-bank financial intermediation sector of any advanced nation. To think about not just the bank implications per se, but also the financial stability implications without any attention to non-bank financial intermediation is a mistake, as demonstrated as early as 2011 as the financial system began to take shape with far more activity outside the regulatory perimeter. It's not to say everything should be regulated, but that which threatens financial safety and soundness needs to be, especially given the Fed's propensity now to bail banks as well as non-banks out at the first sign of trouble. The pending rules, none of them looks at broad financial system implications. None of the pending rules looks at the cumulative impact of each rule in the context of all of the others. They fail first to look at each rule in its own likely impact outside the banks that are directly covered, but also in the context of all of the other rules. And again, banks are profit-making businesses. They will optimize and maximize profitability and competitiveness to the greatest extent possible. There are profound contradictions in each of the rules with those already on the books and those to come, and many of them are perverse and counterproductive and actually undermine safety and soundness, in part by the extent to which they encourage rapid migration of key activities outside the regulatory perimeter.
And Ms. Petru, I'm sorry, but your time has expired, and we'll look forward to getting more amplification during the Q&A. Ms. Tyre, you are now recognized for 5 minutes to give your oral remarks.
Chairman Barr, Ranking Member Foster, members of the committee, thank you for asking me here today. Bottom line, there's no one in the world who understands how these complex proposals interact with each other or the economy. Make no mistake, the future of the financial sector and its structure is at stake. It is wise to make changes in light of the real lessons learned from the March turmoil, but it is hard to understand the rush or how these proposals are informed by the real lessons. There should be a holistic review of how all the proposals work together with a clear vision of what policy goals are desired and with cost-benefit analysis. Time's too tight for the public to meaningfully comment on the many proposals and for Congress to fulfill its oversight role, even with the 120-day comment period. Two important concerns: the international competitive position of the GSIBs and the pressure on regional banks. The largest U.S. banks are among the most competitive in the world. Let us not forget that American economy and our geopolitical strategy are helped by the international reach of our GSIBs, especially at a time when we are nearshoring and rebuilding our industrial base. And yet, certain parts of the Basel III endgame, like operational risk, would disfavor U.S. global banks. It seems odd to hobble GSIBs at this time. We also have a strong regional banking sector, which is unique. Most other developed countries have chosen a banking oligopoly. Congress, as recently as 2018 and on a bipartisan basis, endorsed the concept of tailoring for regional banks. We learned in March and must deal with the fact that mid-sized regional banks can pose systemic risks. But the March problems were of liquidity, largely, not really primarily of capital. So why the large increases in capital now? If the goal of the banking agencies that the U.S. economy should have a barbell banking sector, where only community banks and GSIBs survive, is that their goal? Or is it the goal of the banking agencies that a strong, vibrant regional banking sector is good for our large and diverse economy? Mixed signals are being sent. On the one hand, mergers among regional banks are being discouraged by the uncertain future of bank merger policy and by the high regulatory risk related to required approvals. On the other hand, the overcalibration of the long-term debt requirements and increases in capital seem to be pushing these banks towards mergers. I want to touch a little bit on planning for bank failures. Living wills work. As former Treasury Secretary Geithner once said, plan beats no plan. But they should not be expected to prevent bank failures or ensure that a bank failure brings no pain. Even today, U.S. Army officers are taught that no plan completely survives first contact with the enemy. It is the same for living wills. The way to think about living wills is as a successful decade-long collaboration between the banking sector and regulators that is designed to make the informational flows, operational processes, and around-the-clock work flow more smoothly. Some of the wisest changes in the proposals involve improvements in the content and capabilities. That said, these proposals could be improved. A missing element is to update the playbooks at the FDIC and to test agency capabilities as well as bank capabilities. There are worries about the timing of agency feedback. Congress should be concerned with the fact that there are two different living room wills regimes. Congress should also be concerned with the different standards for credibility and the sudden link to supervisory testing and possible enforcement. Every system can be improved after it has had contact here with the enemy of financial instability. And I hope we end up with sensible reform in this space. There has been unusual public disagreement by the principals in the agencies, which is a tell that something is not quite right. I want to extend admiration and respect to the principals, who I believe are acting in good faith, and to the incredibly hard work of the agency staff in a very difficult year. But once put in place, this framework will be in place for generations. There are too many proposals happening at the same time with too many unintended consequences, the interactions of which we do not understand. Let's make sure that someone is watching over the system as a whole. Thank you.
Thank you, Ms. Rodriguez Valladares. You are now recognized for 5 minutes.
Chairman Barr and distinguished members of the Subcommittee on Financial Institutions and Monetary Policy, thank you for the opportunity to appear before you. For 3 decades, I have consulted and trained professionals at banks and financial institutions, as well as financial regulatory agencies in over 30 countries on risks that can threaten financial institution safety. It's only been 15 years since Lehman Brothers collapsed and globally wreaked havoc on people's lives. It is way too early to say this time is different. It never is. Poorly managed financial institutions fail all too often, painfully disrupting our way of life. Financial instability often follows periods when financial institutions, like investors and policymakers, underestimate risks. Since 2010, when Basel III and Dodd-Frank rules started being implemented incrementally, U.S. banks have benefited from those rules. U.S. banking assets have almost doubled. U.S. banks' net income has risen by 225%. Publicly traded banks have paid out dividends at record highs, and banks' contributions to political campaigns have risen 150%. With those returns on wealth and income, an overwhelming majority of U.S. taxpayers would volunteer themselves to be regulated. Imagine how much better capitalized U.S. banks would be, or how much more they could lend to individuals and businesses if in the last 2 decades their misdeeds had not cost them over $250 billion in fines due to violations in the areas of securities trading, consumer protection, antitrust laws, fraud, money laundering, economic sanctions, and terrorism financing. U.S. banks were resilient between 2020 through February 2023, even while being impacted during the unprecedented economic stress brought on by COVID-19. Basel III and the Dodd-Frank capital, liquidity, stress tests, and living will requirements were critical in helping banks survive unexpected losses. Even as robust as those frameworks are, however, they probably wouldn't have been enough. Fiscal and monetary stimuli bolstered banks' balance sheets and were critical to the stability of the United States. Risks always differ because the size and complexity of markets and banks continually change. In addition to operational and financial risks, banks now also face cybersecurity, climate change, rising civil unrest domestically, and geopolitical threats. Unfortunately, those risks are barely covered by existing or proposed rules. Banks are not at historically high levels of capital. By updating changes to Basel III and Dodd-Frank, U.S. bank regulators are fulfilling their mission of ensuring the safety and soundness of the American banking system. Large banks can meet the updated capital and bank resolution requirements. In addition to issuing equity and subordinated debt and reducing dividend payouts and share buybacks, banks have myriads of other tools to lower their risk weights, known as risk optimization. Examples of such tools include improving data quality to more accurately calculate risks. Banks can reduce holdings of tailored derivatives and illiquid alternative investments. Other risk mitigation techniques include selling loans into special purpose vehicles and using credit derivatives to reduce risk weights. Regulators' proposed rules will not be final until next year, and the implementation would begin 1 to 2 years thereafter. Banks have plenty of time to conduct gap analysis to determine what personnel or technological resources they need to comply. Banks have known for over 5 years that updated Basel III rules were coming, especially since the United States is a long-standing and influential member of the Basel Committee on Banking Supervision. U.S. regulators gave the industry over 120, to comment on the proposed rules. Normally, it's only 90 days. Under no circumstances should regulators withdraw any of the proposed rules. The rule process is working as it should, given that the regulators are taking industry feedback as well as feedback from the public at large. The protection of American citizens is at the heart of why I am here today, and I hope that legislators and regulators share this value as well. Thank you.
The gentlelady yields back, and now I would just make an announcement that the votes have been called, and members will be required to depart to cast votes on the House floor. But before we recess for votes, I'd like to recognize the gentlelady from California, the ranking member of the full committee, for 1 minute.
Thank you very much. Here we go again. Instead of marking up sensible bills that have bipartisan support to strengthen the banking system following the 3 major bank failures earlier this year, Republicans are holding another hearing to attack the Fed, FDIC, and OCC for strengthening our banking system. The hearing title suggests this is a holistic review, but rather than looking at the whole picture, Republicans are focusing exclusively on how proposed changes from regulators will impact Wall Street, not consumers who pay when large banks fail. Millions of people lost their homes, jobs, and savings in 2008. Hundreds of startups almost got wiped out when SVB failed. Regulators should strengthen, not weaken, these critical banking rules to protect consumers from future bank failures. I yield back the balance of my time.
Gentlelady yields back, and as I indicated, votes have been called, and so this committee will need to recess for member votes. I would advise members that we will gavel in as quickly as possible after the final 5th vote has concluded. So if you want to participate, please come back to the hearing room. The committee stands adjourned until votes have concluded. Committee is back in order, and we'll now turn to member questions. The chair now recognizes himself for 5 minutes for questioning. Without objection, I first would like to enter into the record a letter from the Kentucky Bankers Association expressing deep concerns about the recent Basel proposal. And let me start with Mr. Scott, Professor Scott. So the Basel III Endgame proposal will result in a 75% increase in capital of a bank's trading activities, which will be dramatically more significant in the U.S. given the depth and liquidity of our capital markets. Punitive capital charges for capital markets activities disproportionately targets the U.S., where 75% of equity and debt financing for non-financial companies comes from the capital markets and only 10% from bank lending. In Europe, those numbers are essentially reversed. Professor, do you think that the capital markets impact will be more significant in the U.S., particularly given the additional layer of rulemaking coming out of the Securities and Exchange Commission, and can you quantify that impact on end users?
Well, I agree with your assessment. We'll have a very severe impact here. I would point out it's not just the market risk rules, it's also the op risk rules that affect the capital market because they affect the banks that support the market, like custody banks, okay, who are going to look at an increase for op risk. And these are banks that are involved in the capital market. They're not trading, but they're supporting it or providing clearing and settlement services and this kind of thing. So you're quite right that, you know, our economy is really very different than Europe and the rest of the world because of the importance of the capital market to the ability of companies to finance themselves. They go to the capital market. They don't go to the banks like they do most other places. I also agree that when you combine the capital impact that you described with the, 47 substantive rulemakings of the SEC affecting the capital market, and in many ways very significantly, that the combination of these two puts in danger, our crown jewel, in a sense, of having the world's best capital market. So
I agree with you, and I think it would be hugely damaging to our economy. Ms. Tyre, I'm concerned about the onslaught of proposals recently put forward that effectively repeal the S-2155 tailoring law. The Basel III Endgame proposal will massively increase capital requirements on banks of almost all sizes, $100 billion and up. Added to that, we have this GSIB surcharge proposal and proposals for long-term debt requirements, resolution plans, and promises of even more to come. Do we know about the quantitative and economic impacts of all of these proposals and how they work together, the cumulative impact, not to mention the issue of the capital markets?
We don't have any idea, and I don't think anybody does. I think that the folks who work on capital endgame aren't necessarily the same folks who work on resolution planning, and that's the same at the agencies and at the banks. There's some overlaps, and I think a lot of the banks, particularly the regional banks, don't have dozens of people working on this.
Well,
the answer is, we don't know.
As you know, Vice Chair Barr claims that, the other Barr, claims that the Basel III proposal will make the U.S. banking system safer and stronger. But is it true that as government-assigned risk weights go up, a bank's capacity to make certain types of loans is reduced?
That is true.
And will this in turn lead to reduced choices for borrowers and greater uniformity in underwriting standards?
That's correct, and banks will risk optimize, which means they will get out of certain businesses or reduce their scope.
And as a result, will a borrower have a harder time shopping for loans as each bank subject to these rules will increasingly make similar choices on availability and pricing on certain loan types?
Yes, I think the loan types that are going to be most affected are non-listed private companies, and that's a range of small to medium-sized enterprises all the way up to the unicorns, and certain mortgages where there's a lower down payment.
So when these rules force greater uniformity and pricing on certain loan types, does this decrease systemic resiliency because there's less diversity in the lending?
I think that depends, but it's both an issue on systemic resiliency and also an issue on the profitability of banks. Folks think that banks have done super well, but they're trading below book. So that's telling us something.
Well, my time has expired, but I think conforming risk standards will reduce consumer choices and access to credit and actually will increase systemic risk because you're going to have a less diverse banking system overall. My time has expired, and I now recognize the ranking member, Dr. Foster, for 5 minutes.
Thank you, Mr. Chair, and to our witnesses. I am becoming increasingly worried about the potential for internet-driven bank runs and trying to obviously generate instability. Americans connected by social media and armed with 24-hour banking tools pulled more than $40 billion in deposits out of Silicon Valley Bank in the course of about 10 hours on March 8th. So how should we think about the capital and liquidity requirements to deal with that? Part of this was driven by the rumor that the capital had been expended due to bad interest rate bets, and there are issues there having to do with acknowledging mark-to-market losses. But despite the fact that we seem to have put that under control, and the contagion seems to be contained, I'm worried that this is going to happen again. That there's a huge amount of, how do we handle this? For example, is there any way to conduct a stress test to model the behavior of Reddit or short sellers or just bad rumors out on the internet? And what are the lines of defense that we should be putting in place for that? Ms. Valladares, you want to have a first shot?
I think your point, Dr. Foster, is excellent, is that risks are not static. There's always the so-called unknown unknowns, right, to quote Mr. Rumsfeld. And so there are many ways in which you can run simulations for all of these different kinds of things, i.e., how might artificial intelligence affect portfolios? How might the use of social media, cause an explosion of rumors?
But how do you even model?
You can run various.
How do you model short sellers? How do you model?
You can run various simulations as to what kind of an effect it would have, and then you can do simulations as to how quickly might deposits leave a bank illiquid. However, it's precisely because, I'd hate to say it to somebody who comes from a STEM field, you can only quantify so much. At the end of the day, there will be both quantitative and qualitative assumptions, so you cannot perfectly calculate the exact extent. And that's exactly why rules need to be periodically revisited, because while on occasion it may look like banks are really well capitalized, that can turn on a dime. And that's why I think that this kind of hearing, to have these kinds of discussions, is so important. You have to continually revise and update the rules.
Yeah. Ms. Tyre, do you have any idea on how we should reflect that in the capital and liquidity?
So I agree with you that and I'm terrified, I think we have a much stronger risk of internet deposit runs than we had before March. Silicon Valley Bank was tech companies, but I think a lot of local small and medium-sized enterprises that are run by really clever people, by early April, they were also multi-banked. So we've got a greater risk. My own view is that that's liquidity, that starts as liquidity and becomes capital. And what we don't have before us are proposals to change liquidity. And what we don't have before us are proposals, and this would be Congress, to either reform deposit insurance, I think there's no appetite for that, or to give the FDIC back the temporary power that it had before Dodd-Frank to temporarily, for a fee, insure uninsured deposits. We didn't have these deposit runs at the great financial crisis, and we should ask ourselves why. Because now with the internet and all small and medium-sized enterprises being multi-banked, it's very scary.
Yeah, Ms. Petru, do you have any thoughts on that?
I think that the question is really important, and one of the reasons why cumulative impact analysis is so critical, because the way the liquidity rules work now is that based on how much liquidity is required under the various ratios, banks have to have large amounts of, quote, high-quality liquid assets, such as Treasury securities. It's one of the reasons why you've seen the large portfolios of held-to-maturity treasury obligations grow at banks. And that has created one of the perverse incentives to the challenges that we saw at Silicon Valley Bank, because the capital rules didn't recognize AOCI. They proposed to do that. But there are a lot of moving pieces here. And the tougher the liquidity rules, the more high-quality liquid assets banks have to hold, the higher the capital requirements go. And there are some profound sort of interactions there that, as has been said, these rules seem to be made in silos, and there's no indication from any of the agencies how they think about ultimately, could we deal with liquidity another way, as has been said.
Thank you.
New
And
models.
I guess my time is up, so when you figure that out, let me know.
Thank you. The gentleman's time has expired. The gentleman from Florida, Mr. Posey, is recognized for 5 minutes.
Thank you, Mr. Chairman. Mr. Scott, should a cost-benefit analysis be required for all new regulations?
Yes.
Thank you. What does your research say about the cumulative impacts on credit availability and gross domestic product of the current Biden surge in bank regulations?
Well, we really haven't done that. I think we should do that, but, the agencies are the first people that should do that. When rules are proposed, there should be cost-benefit analysis. Now, given the subject of this committee, everybody doing their own cost-benefit on a given rule doesn't get the whole picture, doesn't get the holistic picture. But you're never really going to get the whole picture. We should do a lot better on the mini pictures, okay, before we worry about the whole. So every time a rule is proposed, this Basel rule, there's no complete cost-benefit analysis there, okay? Something that's going to have such a profound impact on our economy, you would think, we would require that. We should do. The Fed's got some kind of ambiguous obligation to do cost-benefit. That should be strengthened, in my view.
What is the lender of last resort function of the Federal Reserve, and what benefits would it have been in the Silicon Valley case?
Well, now you're talking to my real interest, Congressman. We created the Fed in 1913 for a single reason, to be the lender of last resort. We'd given up on depending on J.P. Morgan to do that. He was going to live forever. And we had a number of recessions and economic downturns runs, which Morgan stemmed. But we needed an institution to do this. We created the Fed, not for monetary policy in 1913, lender of last resort. So I've actually published a paper, which I'm happy to give to the committee, analyzing what the Fed did during the SVB crisis as lender of last resort for SVB, which was zero, until SVB actually got into an insolvency procedure. And the Fed, for the first time that I know ever, lent to SVB in insolvency, but never lent to SVB before they got there, okay? Now, why? Was that a decision? There were operational issues. They cut off the Fed wire at 4 o'clock. So if somebody wanted to get money from the Fed or transfer collateral to the Fed, they couldn't do it. Once they realized that wasn't a great thing, they changed that. There was testimony that the head of the Treasury and the head of Michael Barr didn't even know about the problem until 4 o'clock Eastern Standard Time on Thursday. Banks closed on Friday. You would think there were danger signals going on all over the place that this was going to be a problem. They went out to try to raise capital. They couldn't do it. Moody's was going to downgrade them and so forth. There was a real possibility of a run. There should be a war room over there at the Fed in this internet world where things can happen so quickly, where red flags go up, and we now closely monitor the situation. And in my view, the Fed, if it had had better process, could have lent to SVB and probably could have stemmed the run. SVB had plenty of capital by accounting standards. And by the way, everybody knew that the real value of the HTM portfolio was a lot less than they were carrying. It was disclosed. So I think the Fed should tell us, should write a report. They wrote a supervision report. How about writing a report of how they acted or did not act as lender of last resort in the crisis and why?
Thank you. Secretary Yellen testified that she found out about the crisis at the Silicon Valley Bank on Thursday, the day before it actually happened on Friday. You know, what does that suggest about the vigilance of the federal government to prevent financial crises?
Well, actually, she found out about it at 4 on Thursday, and the bank was closed Friday morning. Okay, so it was all over, okay, basically by the time she found out about it. Same with the Fed. So I come back to my point. That shouldn't happen. You know, there should be online, when red flags go off and danger signals go off, Fed should be right on top of that and be able to act quickly.
I see my time's about to expire, so I'll yield back, Mr. Chairman.
Gentleman yields. The gentlewoman from Ohio, Ms. Beatty, is recognized for 5 minutes.
Thank you, Mr. Chairman, and to our ranking member. I'm going to start with you, Ms. Rodriguez Valladares. And I want to talk about Basel III. Let me start by saying I strongly support well-capitalized banks and making sure that we have a financially stable banking system. And certainly, as you will recall, Democrats passed Dodd-Frank at a time of crises because we wanted to ensure that the financial system was strong and resilient. And I think we would all agree that our banks are the better for it. However, as a former small business owner, I know the challenges that entrepreneurs have and that startups face. And I know my colleagues and I are working hard to tear down the barriers and to encourage greater access to credit for small businesses in our districts and communities, especially women and minority-owned businesses. Well, there's been a lot of concern that the new capital requirements will force banks to cut back on lending, or if they don't cut back, we know what happens. That will be passed on, the cost will be passed on to our customers. Can you tell me how this proposal would impact small businesses and the cost and availability of credit?
Thank you for that question. It absolutely, these updated rules absolutely should not lead to a decrease in lending. A much bigger problem at banks is that they often have poor data, no data, or poor processes in trying to understand the needs of small businesses. Empirical data, both from the World Bank, also the Basel Committee, and a number of the other academic studies that I included in my written testimony show that actually the better capitalized the bank is, it creates a lot more faith. That's what these markets are, right? Credit, credere, to believe in. And so when you have banks that are better capitalized, they're safer, their cost of borrowing goes down, their ratings go up, so there is no reason for them to reduce the lending. They sometimes do that precisely because they're looking for other opportunities that are more profitable. If they work on what is called risk optimization, meaning that they can reduce their investments in illiquid, hard-to-value securitizations or very tailored derivatives, if they lower their credit risk weights, that's the denominator, right? You can also work on the numerator by issuing common equity. You can reduce the dividend payouts. So there is no reason why the lending should go down. Moreover, the historical data shows actually how the assets of American banks have exploded precisely because they were in much better condition than the European banks and others.
Let me say thank you, and let me do a little follow-up, but also let me thank you. In your written testimony, you pointed out to us an article on a brief history of banks' capital, and you made a strong statement that banks are not historically high levels of capital, and you went on to explain to us the current measures of capital do not include all risk. And so I want to thank you for that. My next question is, we've heard a lot about the negative impacts of Basel III endgame on access to credit, borrowing costs, banks' balance sheets. Can you address what positive impacts of this rulemaking are other than greater financial stability?
Well, critically, financial stability is very important, but one big advantage is if we stop having so many banking crises, you wouldn't have all of the, the challenge to Americans. I mean, I don't know if anybody of you here have ever lost your job because of a crisis. I have, and I'm fortunate to be very well educated. I've had the privilege of an American education. I know a lot of people, especially if they don't have a college degree, every time there's a crisis or a threat of a crisis, it causes incredible emotional instability for them, and it's hard. I like this idea of doing the economic impact studies on what regulations mean. I really think that we need to require the banks to do a serious quantitative impact study of what happens when people become unemployed. What happens to all of the emotional and mental anguish that they go to and that they pass on to their kids when they can't get a job? And that shouldn't be happening. We have great diversity of minds at the regulatory entities and at the banks, and the heart of everything that we do should be to protect Americans who have absolutely nothing to do with the financial profits at banks.
Thank you. Chair, my time is up.
Gentlelady's time has expired. The gentleman from Tennessee, Mr. Rose, is recognized.
Thank you, Chairman Barr, for holding the hearing today, and thank you to our witnesses for your time and patience with us. I'd like to go ahead and dive straight in. Ms. Tyre, in the long-term debt proposal, unexpectedly, bank regulators decided to propose the debt issuance requirement both on the insured depository institution and the bank holding company, not for the GSIBs, but for smaller regional banks. Can you discuss how this could be problematic for regional banks to comply with?
Well, I think the difficulty there, I'll start with, we're in a rising interest rate environment, and the regional banks and the holding companies and the banks don't have as much debt in proportion as the GSIBs do. I mean, it wasn't really a marginal increase on the GSIBs when we went to long-term debt and TLAC. With respect to the regional banks, it might make sense for some of them. We've had some CEOs come out and say that, but it is going to increase their interest costs at a time when we are looking at a credit crunch. And I think there are some difficult choices to be made about whether it should be at the holding company and at the bank. And there are difficult choices to be made in terms of transition. But bottom line, well done and appropriately calibrated, because it's calibrated too high now, long-term debt and TLAC it's a layer between the, it's a layer that protects the uninsured depositors and the insured depositors, AKA the Deposit Insurance Fund. So I guess I say it could work, but it's been calibrated way too high, and I think there should be deep concerns about transition periods.
Thank you. I appreciate that insight. Shift gears. Professor Scott, I came across some of the work that your firm did on the pace of the SEC's rulemaking agenda. As you are aware, the SEC under Chair Gensler has embarked on a rulemaking agenda for which scope, scale, and speed are wholly unwarranted by any congressional mandate. These are serious concerns. There are serious concerns that many of these proposals will be thrown out in court following decision in West Virginia v. EPA. Professor Scott, does the SEC in its economic analysis factor into its rulemaking the costs associated with potential litigation?
Costs to the SEC of litigation or to the general economy?
To the general economy.
No. A bigger picture answer to your question is that the cost-benefit analysis, the SEC, kind of focuses on the cost to institutions, like how much is it going to cost a bank to comply with XYZ rule. Actually, that's a small part of what we should be worried about in cost. It's the cost of the economy, okay? How are these rules going to affect the economy? And that is almost never done, or if it's done, it's not done very well. I've been through all the cost-benefit analysis of all these rules, and it's woeful. It's woeful.
Professor Scott, isn't it true that Chair Gensler is issuing a large number of rulemakings that are not required by statute?
Yes. I have the numbers on that in our report. I think he's issued 47. Only 8 are mandated by statute. So you can go back to Chair Shapiro, who had a number of rules during the implementation of Dodd-Frank. 44% of her rules were mandated by. So this is discretionary. These rules do not have to be done, okay? And I'm looking for sort of what's the problem we're trying to solve? Our capital markets are very strong. They're performing very well. What's the problem?
And Professor Scott, stress tests generate binding capital requirements in the stress capital buffer, but the Fed to date has failed to publicly disclose, let alone issue for public comment by rulemaking, the models, mathematical formulas, and other decisional methodologies that it uses to calculate firms' legally stress capital buffer requirements. Do you believe this violates the Administrative Procedures Act?
Yes.
Thank you.
You're welcome.
I see my time is expiring. I yield back.
Gentleman's time has expired. The gentlewoman from Massachusetts, Ms. Presley, is now recognized.
Thank you, Mr. Chair. The 2008 financial crisis led to a recession that stunted a generation of economic growth. When Congress passed the Dodd-Frank Act, the purpose was clear, which was to prevent something like the 2008 financial crisis from happening again. These regulations were intentional and responsive to catastrophic mistakes. Consequently, it comes really as no surprise that after Republicans undid those regulations, rolling back aspects of the Dodd-Frank law in 2018, we are seeing financial collapses like the SVB failure earlier this year. Ms. Rodriguez-Valladares, isn't it true that as a result of the 2018 Republican deregulation bill, SVB was allowed to opt out of capital requirements relating to AOCI?
S2155 was incredibly detrimental in the sense that banks that were in that 100 billion to 250 billion were no longer domestically important, and that's absolutely critical. Hence, not only did they not have to do the level of stress test, they also did not have to calculate, or worse yet, publish the liquidity coverage ratio. So that part of the law was incredibly detrimental. Mind you, that bank was poorly mismanaged, and the evidence was there. Since 2016, they had repeatedly violated anti-money laundering processes and a whole bunch of other processes. So those size of banks need to be considered domestically important. It's critical for the American economy, and they need to be better supervised, no matter where we are in the interest rate environment. I'm a little concerned hearing that we may or may not like a rule because of the elevated interest rate environment. Right now, we're at an elevated interest rate environment. We weren't 20 years ago, and we're not likely to be there in 2 years. So we have to think of these rules across various economic cycles, not just right now. And on the stress test, the minute that the Fed were to disclose the design of the model and the formulae, then it becomes a plugging in the numbers. So if there were to be some kind of a requirement that the Fed has to disclose the models, then it would be absolutely imperative that the banks disclose their models, because it's the banks that design the models and choose what quantitative inputs to put based, of course, on Fed scenarios.
And thank you for your expertise, and also for sharing your lived experience and underscoring the human impact here. And again, this did result in SVB seeming better capitalized than it actually was, considering the large unrealized losses in their securities portfolio. So in fact, the Fed estimated that because of the AOCI opt-out, SVB's capital ratio was inflated by nearly 2%. Banking regulators are trying to fix a very real problem, a problem that directly contributed to this year's bank failures. Ms. Tahar, when you testified before the committee in May, you stated that, quote, the not passing through AOCI in capital, which is something that has been on the books since 2013, should be revisited, end quote. Ms. Tahar, do you still stand by your statement in May, yes or no? I agree with those comments that you made on the record.
Yeah, got the mic on, but yes, of course, I stand by them.
Okay, thank you for reiterating that. and I certainly agree with the comments that you made on the record in May. Well, the regulators are revisiting it, and the proposed rule would require regional banks with more than $100 billion in total assets to include AOCI in the regulatory capital. Lack of adequate capital was absolutely a contributing factor in the 3 bank failures this year, and I support the regulators in strengthening them. My colleagues across the aisle are not serious about preventing future bank crises, even when it comes to stress tests, which are critical for evaluating the safety and soundness of banks. They complain that stress testing is too, quote unquote, opaque. Ms. Rodriguez-Valladares, the purpose of any test is to find both strengths and weaknesses.
Yes, absolutely. And stress tests are critical. Please understand that regulators have not only capital stress tests, they also have liquidity stress tests. But if you don't require a bank to measure the liquidity coverage ratio, then the regulators don't have that information. Those of us in the industry, I can take the balance sheet information from SVB and I can do my own simulations, but I'm never going to have the level of granularity that would be really, really helpful to all of us.
Well, after witnessing some of the largest bank failures in our history earlier this year, our response must resemble how we acted after the 2008 financial crises. We need stronger capital requirements and meaningful stress tests for a safer financial system. Thank you.
Gentlelady's time has expired. The gentleman from Wisconsin, Mr. Fitzgerald, is now recognized.
Thank you, Chairman, and thank you to the witnesses. Chairman Barr expressed a desire to assess how the Federal Reserve performs analysis on bank mergers. This follows the DOJ plans to update guidelines on banking mergers to provide more robust scrutiny. I strongly believe antitrust analysis should be governed by the rule of law and not the individual views of those who, at any particular point in time, head the relevant agency. I'm concerned any change in that analysis that would depart from long existing and widely accepted standards may not reflect actual changes in the competitive environment. Further, we've talked in this committee many times, the capital proposal from the Fed and other financial regulators, on top of other recent regulatory proposals, is bound to lead to some type of consolidation to overcome the compliance burden of these rulemakings. Ms. Tyre, what do you believe will be the net effect of the Biden administration and its regulators sharply increasing the regulatory burden on banks with more than $100 billion in assets, while simultaneously making mergers between those banks more difficult to close?
I think we have a very unhealthy market for bank mergers. As I said in my testimony, the regulators are sending mixed signals. The bank merger guidelines have not been updated since 1995. That's not only pre-internet, that's pre-fax. It's virtually pre-email, and not everyone had email back in those days. The world has really changed, and these bank merger guidelines have kind of been in the air now for almost 2 years and nothing's happening, and it's high regulatory risk for any banking management to go to their board and say, we want to sell. So I think this is going to have an adverse impact. I think we're better off with a healthy bank regional market where the strong can buy the weak. That's going to have less banking crises. I think sharply raising capital on regional banks at this moment is the wrong move at the wrong time. And I'll just stop by saying AOCI is not Basel III endgame. It's something very different. And so revisiting AOCI isn't the same thing as saying all of these other changes. There's not a trail of breadcrumbs from revisiting AOCI to all of the many other changes. I hope I've responded to all your questions.
Yeah, and under the capital requirement proposal, corporate entities must have securities, and they must be listed on an exchange, right, to benefit from a reduced risk weighting. So this whole approach ignores smaller non-public companies that rely on banks for funding, right?
I completely agree with that. It ignores a range of companies. We've got some really large, major tech unicorns that are stable that we should be encouraging banks to lend to. Then we have the kind of small and medium-sized enterprises that are the backbone of our economy, particularly in smaller market cities. And then we have my son's micro production company in Los Angeles that probably should get a higher risk weighting.
Right.
But that's probably, that's a mini company from a very young guy. But to treat my son's company the same as name your favorite tech unicorn or name a contracting company in Raleigh, North Carolina that's been there for 100 years makes no sense.
Thank you. So in the 1 minute I have left, the proposal from the Fed and the other financial regulators would impose obviously huge costs on regional and mid-sized banks with little to no trading books to adopt the governance and data processes. Ms. Petru, can you discuss how the Basel standard just is poorly suited for these smaller banks?
I think they'll be extremely difficult, partly because the new proposals, as you know, impose market and operational risk requirements. And I think buried in the bowels of the proposal is a request for comment on whether or not the market risk rules should apply only to banks which have material market risk. I think that's a really important point, because otherwise for these smaller banks, and this is true also in a different way for operational risk, they're going to be doing tremendous amount of work and ultimately holding unnecessary capital that could go to lending to underserved borrowers for risks they're not even really running, that aren't material to safety and soundness.
Thank you. I yield back.
Gentleman's time has expired. The gentlewoman from California, Ms. Kim, is now recognized.
Thank you, Chairman, and thank you, and this is for being with us today. I'm deeply concerned that the Basel III Endgame and the other proposals would make credit more expensive for small businesses, as they will reduce lending for low to moderate income households and put our banks at an international competitive disadvantage. Furthermore, these proposals do nothing to prevent future failures like SVB. So it has been reported that certain European countries want carve-outs on their own Basel III Endgame proposals to protect their banks from the increased cost of higher capital requirements. And in Asia, 3 of top 10 companies in the world are giant-sized, state-owned Chinese banks that aren't planning to implement the Basel framework anytime soon. So, Ms. Tyre, in your written testimony, you speak of the competition between our banks and European and Asian banks. So can you describe how the changes in the changes to operational risk and the surcharge could put the U.S. banks at a competitive disadvantage with banks headquartered in Asia and Europe?
I think the impact is going to be mostly on our largest banks, the G-SIBs that operate internationally and who are in direct competition with their European and Asian peers. You're clearly right about the Chinese banks. They're not going to be subject to anything near the same set of rules. The European banks have very much a fundamentally different business model, less reliant on fee income, and there's less regulatory intensity, for better or for worse, so there's many, many fewer regulatory fines, which will have a long tail even after the problem has been solved. So, as I said in my written testimony, I don't know why we're trying to hobble our hugely competitive banking sector right now, particularly with the geopolitical situation we're in. In terms of small and medium-sized enterprises, I'm deeply worried.
Yeah, thank you. You know, let me turn to domestic implications of the proposals. One of the best ways to build wealth and reach the American dream is to own a home. Unfortunately, these high interest rates and inflation is making home ownership and the American dream unattainable. So we know that because the mortgage origination is at a 28-year low. So, Mr. Tyre, in your view, in your view, what kind of home buyers would be pushed out of the housing market with the new risk weight for mortgages?
So, when I was young and just starting out, I put down 5% on my first house. My starter house was 5%. So I'd be priced out of that market now. And I think that is going to be mostly low and medium income buyers who do not have parental help, right? Because we know that so many young buyers these days only do it with parental help. But for people who are making their way up the ladder, they're more likely providing income to their parents rather than getting parental help. Those are the kind of people who are going to be disproportionately affected here.
That may include my children, too. Yeah. You know, Mr. Scott, in your testimony, you say that the regulators' proposals could reduce U.S. GDP by more than $67 billion per year. Out of the plethora of proposals, which proposal would you say will have the highest negative GDP costs?
I wish I could answer that proposal. I was citing a study really by BPPI who came up with this number, and I don't know, which particular regulations underneath this. But in terms of looking, just my instinct on this is kind of in my testimony. I think the market risk and operational risks part of Basel have such an impact on our capital market, which, as I testified, is very important to financing in this country. I would look there.
Let me ask you another question. Can you talk about how the stress test and stress capital buffer already account for risk associated with the operational failures? Do you think a separate capital requirement for operational risk, as called for in the intent Basel III Endgame proposal, is necessary, or is it duplicative? That is, could there be some double counting going on?
Yes, I think there's double counting, and there's two ways to eliminate it. Take it out of the stress test or take it out of Basel, or some combination of the two. That should be done.
Thank you. With that, I yield back.
Gentlelady yields. The gentlewoman from Texas, Ms. De La Cruz, is now recognized.
Thank you, Mr. Chairman, for holding today's hearing, and thank you to the witnesses for appearing today. Professor Scott, you heard Ms. Rodriguez Valladares say massively raising capital requirements as contemplated by the Basel III Endgame proposal will not decrease bank lending. Do you agree or disagree?
I disagree with that. There are numerous studies, BIS, which, Bank for International Settlements is a widely acclaimed source. It's neutral, it's not political, says that, higher capital decreases lending. The question is how much. You can argue 1%, 4%, but it's directionally certainly decreases it.
And besides the studies, have you also been able to speak to institutions of regional institutions on how they feel it would affect their lending?
Yeah, well, I haven't done a scientific survey, but I do talk to banks, and I think any banker I've ever talked to, has said higher capital increases decrease lending.
Now, I'm concerned about the cost to my constituents that the recent bank regulatory proposals will generate. And that is especially the case for the so-called Basel III Endgame proposal to massively raise these capital requirements, as just discussed, and that it would choke off credit availability and increase credit costs to families and small businesses in my district and across the country. Ms. Tayer, do we know how all the recent complex and wide-ranging proposals with maybe more on their way will have an effect on consumers and small businesses?
We know there will be an effect on small businesses for sure. On consumers, I think that's a little bit less clear. The key thing we don't know is how all of these proposals interact with one another and where all the unintended consequences will be.
And what kind of effects do you think they will have on small businesses?
I think that the lack of a preferential weight for small businesses who are unlisted and even larger businesses who are unlisted in a time period where our economy is increasingly reliant on unlisted companies, and we know where many of the jobs come, which are small and medium-sized companies. It is not going to be a good story for credit to those companies.
Now, have the regulators making the proposals provided any solid analysis of what these effects may be?
I don't think so.
My district is heavily ag, and ranchers, farmers being a large part of my constituents. According to a USDA report, nearly 50,000 U.S. farms use futures or options to hedge risk. Mr. Scott, due to increased market risk capital requirements imposed on banks, are all of the farmers and ranchers going to be subject to higher costs when hedging risk?
Yes, because if we increase the capital associated with taking a position in a derivative, it's going to increase their costs.
So by increasing the cost, is it fair to say that this will put a burden on our American farmers?
Yes.
That being said, farm security, national food security is national security. So this is of great concern for me. Again, my district is largely served by regional and small banks. These banks are critical to our economy and to the banking ecosystem in my area. Ms. Tayer, what impact will the recent proposals have on regional banks and banks even below $100 billion seeking to grow?
So I think 100 billion and up is going to be a sharp increase in their costs, interest rate costs, capital costs. It's a very good question that you're asking about 100 billion and below, because if you think about the 50 billion to 100 billion who are largely, those are regional banks that are in one state or many or two. What I understand anecdotally from my regional bank clients is that they provide loans to small businesses in smaller towns, smaller markets, to agriculture. Agriculture is
Sorry, the
very-
gentlelady's time has expired.
I yield that.
I'm sorry to cut you off, but the time has
worries.
expired. And now the gentleman from Texas, Mr. Williams, is recognized.
Thank you, Mr. Chairman, and this would be to you, Ms. Petru. Ms. Rodriguez-Valadares testified that the bipartisan regulatory tailoring law, S. 2155, contributed to the bank failures in March of 2023. Were those bank failures more about interest rate risk and deposit concentration risk, or did SVB fail because it was not subject to one-size-fits-all capital requirements?
Sorry, are you addressing
Well,
it to me?
no, it's to Ms. Petrone.
This is why I wanted to wait, yeah.
I think, first of all, the banking agencies had tremendous discretion under that law to set standards based on risk. And in fact, importantly, they reserve their right to regulate banks regardless of the tailoring if they saw risk forthcoming. And I think the problem was far more supervision than it was tailoring, because the banking agencies didn't tailor that much, and they didn't supervise hardly at all.
Okay, thank you. The Federal Reserve, FDIC, and OCC have been bombarding our financial system with excessive regulations and dangerous proposals like Basel III Endgame, long-term debt requirements, resolution planning, and GSIB surcharges. It is concerning that multiple of our federal banking agencies are rolling out these proposals one by one in a rush fashion without considering how these combined regulation requirements will impact innovation, limit access to capital, and threaten economic stability. So regulators should provide an analysis of the potential effects on any proposal that makes significant changes to our financial regulatory framework. Our mission and the mission of regulators should be to allow the economy to thrive, not tighten their grip on the financial system. So, Ms. Tayyar, do you believe the cost, benefit, and impact analysis conducted by the agencies for these proposed rules adequately address the negative consequences or potential ramifications, and have regulators properly considered how these proposals will interact with one another?
No, I don't think the cost-benefit analysis goes as far as it needs to, although they've, particularly in Basel III Endgame, they've tried very hard, but there's a lot of untested assumptions and very little empirical study. There's nothing out there, nothing, that looks at the proposals across the proposals and thinks about them overall.
Okay, thank you. Now, as we've discussed over the past few meetings of this committee, Basel III endgame proposal will severely reduce financing and access to capital for small businesses. Federal regulators are continuing to try and place banks at a disadvantage and use the bank failures from earlier this year as a weak justification for this rewrite of bank capital regulations without fully considering their impacts. These proposed changes will dramatically affect the banking community, and there is legitimate concern that the Basel revisions will have broad impacts on Americans' ability to access reliable credit and increase overall borrowing costs for individuals and small businesses. These increases in costs will make it harder for Americans to obtain a loan. Whether they want to start their own business, expand current business operations, or buy their own home, small businesses and everyday Americans rely heavily on loans and credit lines from banks of all sizes to access the capital they need to do so. So when I meet with Texans back in my district, and I might say I'm a borrower myself, I'm constantly hearing about how scared they are of regulators' out-of-touch proposals and fear that this administration will do what they'll do next to continue the attack on the financial industry and, frankly, Main Street America. So, Mr. Scott, could you elaborate on how Basel III endgame proposal will impact bank lending and the cost of credit for borrowers, and what does this mean for Americans trying to obtain a loan?
Well, it's not a good story. It will increase costs for the banks. They either will exit certain activities because of that cost or raise their fees. That will mean higher costs to borrowers and consumers, and overall will not be good for the Texas economy or the economy of the United States.
Well, we know it's all passed down to the consumer.
That's correct.
Eventually gets into cost of goods sold and drives people out of the markets. With that, Mr. Chairman, I yield my time back.
Gentleman yields, and the gentleman from California, Mr. Sherman, is now recognized.
Thank you. We're looking at cost-benefit analysis by those who think that we should have lower standards, lower capital standards. And one of the reasons for that is when you do the cost-benefit analysis, you leave out the social costs, the political costs, the cost to the fabric of our society. Going back to what caused Basel III, namely the 2008 meltdown. If you just look at the economics, you can say, hey, we actually made money bailing out the banks. No cost. Cost-benefit analysis. That may be true. We lost some money bailing out the auto companies. Maybe we should have held the stock a little longer, but that's a side issue. The reason for that was that they came to us with the Toxic Asset Recovery Program, TARP, and a lot of us put some pressure on, and they ended up buying preferred stock rather than the toxic assets. Had they bought the toxic assets, we would have lost hundreds of billions, and the effect. But even with us not losing any money on the bank bailout, the damage to the social contract. How many of us have been told by every group that wants anything, well, you gave it to the banks, give it to us. And then this was added to by the Silicon Valley and New Republic problem, which just added to this idea that banks are bailed out, nothing really is fair in our society, and give me mine. We're told that we can't possibly know the effect of these new regulations, and we can't. But we also can't possibly know the effect of not adopting these regulations. That's the thing about the future. Now, I'm concerned, Ms. Valadares, about the effect this is going to have on IPOs. How will these standards discourage banks from participating in IPOs and otherwise in the capital markets?
The question is for whom?
For you.
Oh, right. There is no reason it would discourage IPOs.
Do the other witnesses agree?
No.
Okay, I'll hear from both sides then very
Right.
quickly.
So there's, sorry.
Go ahead.
Yeah.
Right. There is an initial public offering right now. In fact, for many companies, many of them might prefer it because of the elevated interest rate environment, right? So there's no proof that having banks that are safer is going to impact IPOs. Banks that are
Right,
safer.
but if you particularly raise the capital requirements on that segment, it's going to cause the banks to do less in that segment.
It wouldn't.
I'll ask the witness next to you whether she has a quick comment, because I got to go on to another subject.
Sure, thank you, sir. We're in a secular decline for IPOs over the last 10 years. We have to understand we have fewer and fewer public companies, the pressure from many parts. There will be greater operational risk and fee capital, and I think on balance that's going to be more than the lack of preferential weights on unlisted companies.
Okay.
So I think it's a risk.
Thank you. I want to go on to another thing, and that is raising capital standards is the bluntest way to assure banks don't go under. The better way to do it is to look at the individual assets and do good bank examination. And that is where I think our regulators have failed us, because they've ignored interest rate risk. Now, when you pay attention to credit risk, that's a reason not to make a loan to a local government. When you pay attention to interest rate risk, that's a reason to not buy a 30-year treasury. Well, how did Silicon Valley Bank was famous for loaning money to startups, and yet they lost their money by buying the 30-year treasuries. And we still see a situation where, and I have legislation on this, the stress tests don't look at the number one stress is what happens if interest rates go up. As a matter of fact, they once did a stress test about what happens if interest rates go down, which isn't a bad stress test, but isn't so bad. The one other illustration of how poorly crafted regulations can necessitate higher capital rates is they're going to give no credit to private mortgage insurance. In what world is private mortgage insurance irrelevant to the creditor? As a matter of fact, the creditor is the one that makes sure that the home buyer gets the private mortgage insurance. So I'd have a lot more faith in these rules if they looked at a little bit, didn't use the blunt instrument of just raising the rates and instead looked at better bank examination. I yield back.
Thank you. The gentleman yields back. The gentleman from Tennessee, Mr. Ogles, is recognized.
Thank you, Mr. Chairman, and thank you all for being here, and our apologies for having votes and kind of getting you stuck. But Mrs. Tyre, my colleague De La Cruz had asked a question. You were cut off because time ran out. But the answer, which you were not able to complete, is of interest to me because I have multiple regional banks in my district and in Tennessee in general. So please continue. I think you dropped off at 50 to 100 billion
Sure.
category.
Thank you very much, sir. I think the question was about the pressure on regional banks, 50 to 100 billion and then 100 billion and up. And I think even aside from the capital rules, the increase in deposit run risk has put a lot of pressure on those banks. Those banks also have to have a lot of technology investment. And then there is the increased intensity of supervision as well. So what we're seeing is a sector of the economy who makes the most loans to farms, makes the most loans to small and medium-sized enterprises in smaller markets, and really takes the most deposits from counties and states, et cetera, they are under enormous pressure. And, I think we have to ask ourselves, we're a big, diverse economy. We've got a regional banking sector. We're among the only countries in the world to have it. I think we should be very, very careful before we say we want to put extra pressure on this portion of the banking sector.
Well, and I think you touch on, so when you look at additional pressures, you have the regulatory regime, there's additional costs. Is it fair to say that as a bank, takes on more or additional costs, that's going to be passed on to the consumer?
Yes, sir, it will be.
Would it affect their ability and perhaps their liquidity on investing in their community, whether it's farms or small businesses or mortgages?
They will come under pressure. It may well be that some consolidation in that sector makes sense, but I do think we want to stop before a place where we've only got 12 financial institutions in the country?
Well, so we're seeing, and this is kind of a broad statement, we're seeing on the onslaught of proposals from our Democrat-appointed federal banking regulators being pushed out in a hurry with little to no supporting analysis, and that's been touched on rather extensively here. Many are being pushed as a response to bank failures and stresses in March, but the wide range of the proposals goes far beyond anything that could reasonably be associated with March. And I would agree with my colleague, Mr. Sherman. I think blunt instruments or one-size-fits-all type solutions is problematic. And so whether it's the regulatory regime, whether it's the Basel III, I mean, it's been touched on here that when you look at the banking sector of Europe, it's entirely different than what we have here in the United States versus the types of loans and liquidity that are offered. And so I have concerns that we're subjugating ourselves to an agreement that, Mr. Scott, are we held to Senate confirmation on this agreement?
That's been a long-standing question about what the Congress's supervision should be over this entire Basel process. But I must say, given its impact, okay, I think there should be much more legislative control over this process than has existed in the past.
Well, so you're aware, when you look at the benefit analysis that's been produced by the federal banking regulators in trying to justify their proposals, and Mrs. Tyre, you touched on it as well. I have concern when you look at the analysis, when you look at proposals added together, the effect on the downstream impact, whether it's on small businesses, the regional banks. So really quickly, we have just a few seconds. What's your primary concern with the Basel III, Mr. Scott? And you may get the last 40 seconds.
Well, my primary concern is, and I agree with Congressman Sherman, that we need to take all costs and all benefits into account here.
Such as interest rate risk, liquidity
Everything,
risk, et cetera.
okay? I mean, the point's been made. We're not even looking in the stress test today at interest rate risk, which is what caused these three banks to fail. So we need to do a much better analytical job of evaluating these proposals.
Mr. Chairman, thank you all again for your time. I yield back.
Gentleman yields. Gentleman from South Carolina, Mr. Timmons, is recognized.
Thank you, Mr. Chairman. The FDIC's proposed rule on long-term debt aims to enhance the financial stability of specific large banking organizations that are not classified as globally systematically important. And while I acknowledge the rule's intention of safeguarding the financial system and depositors, I believe there are several critical issues that require more in-depth consideration before its enactment, as well as the proposed rule general real-world effectiveness. One of my most ever-present concerns is that the rule does not adequately consider short-term transition costs, the potential interaction with Basel III reforms, and other indirect and unintended effects on borrowers. I'm particularly concerned with how Basel III capital requirements may exacerbate the strain on bank capital availability, compounding the effects of this proposed LTD rule. Not to mention the fact that billions of dollars of commercial real estate projects must be refinanced in the next 36 months. And not all those projects will be profitable when their mortgage payments more than double, and banks are prevented from extending additional credit due to increases in capital requirements and an unfavorable interest rate environment. That is the looming crisis that we need to be preparing for, not further restricting capital availability. It is imperative that these unaddressed aspects undergo a thorough evaluation to prevent unintended adverse consequences. We need to know what the harm could be and assess the impact of real-world modeling. But in July of this year, Vice Chair Barr stated his support for then upcoming proposed rule on long-term debt during a speech at the Bipartisan Policy Center, stating, and I quote, "If SVB had enough long-term debt outstanding, it might have reduced the risk of a run by uninsured depositors, and it might have given the FDIC more options to resolve the bank or merge it with a healthy institution." So, Ms. Tyre, do you concur with Vice Chair Barr's assessment? Do you believe that the LTD requirement in its current state would have prevented the failure of SVB given the scale and speed of deposit withdrawals that the bank faced?
I part agree and part disagree. I think Silicon Valley Bank happened so fast, nothing could have saved it. But I do agree with the Vice Chair Barr that a properly calibrated, with an appropriate transition, long-term debt requirement can be a helpful layer between that would protect depositors. I just worry that what we have here is not well calibrated and has too quick a transition.
But you do agree that if this proposal was in effect at the time, it would not have caused SVB to be fine. I think that's the ultimate question.
There's nothing that would have caused SVB to be fine.
Well, if Congress hadn't spent $7 trillion, that we didn't have an increased inflation resulting in increased interest rates, SVB would still be fine. But that's neither here nor there. Mr. Scott, we actually have a real-world example from earlier this year to study on this subject. In Switzerland, authorities imposed significant losses on certain Credit Suisse bondholders as part of their efforts to resolve the failing bank and consummate a merger with UBS. Can you comment on those instruments, on whether those instruments would have proved effective in resolving Credit Suisse had they been honored as intended?
The answer is no, I can't, because as you probably know, that's the subject of a lot of back and forth about what the actual terms of those long-term debt agreements were and whether the Swiss authorities were acting correctly in imposing losses on those people. So, and you know, what happens in Switzerland and their rules be very different than ours. So I really can't fully answer that question.
Okay, well, let's look here. So in March, the federal banking regulators couldn't stomach imposing even fractional losses on extremely large uninsured depositors at SVB and Signature, forcing the American taxpayer to bail out their uninsured depositors. So going forward, do you think federal banking agencies will actually impose real losses on bondholders of a failing bank as instructed by their long-term debt proposal, or do you think they'll go the Swiss route and bail them out again?
Quite frankly, Congressman, I think we have a history of not wanting to see what happens when we don't bail out banks, okay? That was the whole message of 2007 and 2008. We didn't want to see. We did it with Lehman. Oh my God, look what happened. We shouldn't do that again. So I'm skeptical whether all of these resolution procedures will actually be used when people contemplate the contagion consequences to the economy of using them.
I hear you. It just seems that Washington keeps creating a crisis after a crisis and then creating a solution for that crisis that it created. And we got to stop the cycle. Thank you, Mr. Chairman. I yield back.
Gentleman yields. Gentleman from Texas, Mr. Green. I think you're the caboose.
Thank you, Mr. Chairman. And let me thank you for having a panel that is more reflective of society and of the capable, competent, and qualified persons who are available to serve as witnesses. So I thank the witnesses for appearing as well. Friends, we have empirical evidence indicating that there is a need for us to give some additional assurances that we won't have another Silicon Valley, that Wells Fargo, we all aware of what happened there, so I don't have to go through the details. But how would we adjust for some of these egregious circumstances being simply a part of doing business if we allow things to continue? Just a part of doing business. So you build into your business model a cost for these egregious circumstances. And you're prepared. If you don't get caught, nothing happens, you live happily ever after with a coffer that is overflowing with dollars or cash. And if something does happen, well, you've already considered this in your business model. So Ms. Rodriguez Valladares, would you respond, please, to my thoughts?
I think, unfortunately, there's incredible recidivism. You have banks that over the last 2 decades have ended up being fined over $250 billion US. That's just here. I've worked on a trading floor and I work with banks all the time. I've seen firsthand fraud. I've seen misuse of data. I've seen all kinds of cover-ups. And it has to do with enforcement, right? When the Barr report came out, I actually didn't read his report because I knew he wasn't there and I knew that he wasn't his bank examiner. He wasn't a bank examiner. I first read the CAMEL's reports, capital, asset management, earnings, liquidity, and sensitivity to market risk. SVB was having problems, serious problems with violations of anti-money laundering processes. To me, that's always a signal that if you can't even get your processes right for anti-money laundering when you know that the feds could come in, you're gonna have problems with everything else. There were problems with modeling, there was problems with data, they weren't measuring interest rate risk properly, they were basically illiquid. The examiners, if you read those reports carefully, the examiners did their jobs. What happened is, where was enforcement? And so I advocated in May when I spoke before you previously over at the Senate Banking Committee, we need an independent analysis of what happened with SVB. We don't know what happened. Why wasn't enforcement escalated? No amount of capital, no amount of proposed rules are going to help if once examiners detect a problem, if they're ignored. If there's no enforcement, then I'm gonna be here hopefully in a couple of more years, and it's gonna be another $250 billion in terms of fines. Banks need to be accountable.
Well, do you think that, in addition to what you've said, that some of these large businesses with these huge profits, that they are amenable to taking the risk because they know that the enforcement's not there, and if they succeed, they've enhanced their coffer. If they do not succeed, they're prepared to pay these fines that you've called to our attention and move on?
Absolutely. Executive compensation absolutely has to be reformed. When I worked at JP Morgan, I was paid not only on what I did, but also how the rest of the bank, how all the traders around me did, right? And so the incentives are really, really messed up, because what that means then is that even when somebody at a bank is trying to do the right thing, and they see that somebody over there is taking on too much risk and may cause the bank to implode, they're not gonna tell anybody because my bonus would be impacted. Does that make sense? So you really have to reform how people are paid at these banks, especially executives, right? If the rest of us did what SVB's CEO did, we'd all be in jail. He went to Hawaii.
Thank you, Mr. Chairman. I yield back.
Gentleman's time has expired, and that will do it. I want to thank our witnesses for their testimony today. Without objection, all members will have 5 legislative days within which to submit additional written questions for the witnesses to this chair, which will be forwarded to the witness for the response. I ask our witnesses to please respond as promptly as you are able. This hearing is now adjourned.